You're watching Investor's Guide on ET Now. Thank you for tuning in. Now, we know that you hear all kinds of buzzwords when you're investing in the market. Right now, people are talking about infrastructure and power coming back. They're talking about interest rates going down, so maybe banking will make a recovery. Over the next half hour, we'll tell you why you should focus on the plan you have right now and not get distracted by buzzwords. Grab a pen and paper, write down the email ID that's at the bottom of your screen where you can send in any question you have about your money. You can also reach me on Twitter. Let's get straight to it. Over the next half hour, we'll help a young businessman streamline his investments and figure out how he should plan as an entrepreneur. In our product review, we focus on the TATA Infrastructure Fund, and we'll tell you if you can buy a term cover and a health cover if you're an NRI. All right, it's time for me to bring in Dhirendra Kumar, the CEO of Value Research. Dhirendra, thank you so much for joining us. Let's get straight to our portfolio question. Well, Avinash has written in Dhirendra. Now, he tells us his goal is to build a retirement corpus of 2 crore rupees and save for his child's future. He's a 28-year-old young man, and currently he and his wife don't have any children, but they're planning on starting a family next year. Now, you think this is an ordinary case, but there's something different about Avinash's portfolio. He tells us he's working in a family business that's currently being run by his father. Now, he has 60,000 rupees in fixed deposits. He makes 30,000 rupees every month, and he can save 20,000 rupees every month out of the money he earns. Now, the difference between him and any other salaried person that we give advice to is that the money is not guaranteed to come in at the same pace every month, which means that he can't make an SIP commitment. He currently invests in the ICICI Prudential Focus Blue Chip, Reliance Equity Opportunities, and IDFC Premier Equity Plan. He wants to know if these investments will help him achieve his goals. Dhirendra, you yourself are self-employed. Tell us right now, for someone who's watching, who works in a family business or who's an entrepreneur, how should his portfolio be different, or how should he approach his investments differently than from a salaried person?
Even if you have a business, even if you have a self-employed, you should factor in the cyclicality of it, understand the understand the stability of that business or stability of revenue on which you can bank upon, and that helps you enforce a discipline that how much salary are you taking, because the rewards for owning a business, because you are being rewarded for assuming the risk and driving a business, and from that standpoint, I would like to think that your 100,000 rupee, 1 lakh rupee should be an emergency fund. And maybe an emergency fund because you are planning to start a family, but it all depends. You are the best judge because you understand how much liquidity is there in the business, what kind of self-employment you have. Looking at your investment portfolio, I think it looks very good. It looks a very thoughtful portfolio. Resist the temptation of adding more. The only thought which comes to my mind, and it's not a mistake in your portfolio, I would say that when building a portfolio for the long run, have the constituents which are flexible, and from that standpoint substituting your ICICI Prudential Focused Blue Chip with a dynamic fund might be a better idea.
All right, so one little change there among your funds, but you seem to be on track. Now, the thing obviously that worries me about your portfolio, Avinash, is that there's no mention at all of insurance. I would like you to get insurance for yourself. Buy a policy that also covers maternity for your wife. There'll be a waiting period of a year, so that should be just in time. Also, make sure both of your parents are insured, so you have enough health insurance, and then buy life insurance for yourself as well, especially if you're going to start a family at your age. That should be really, really affordable. Make sure you do that. And of course, Dhirendra there telling you how to approach being a businessman and an employee, and Dhirendra is someone who has a lot of experience in that area. Let's move on to our next question. Vidhi Mehrotra writes in. Now, she tells us she can save 10,000 rupees every month. She wants to put that money aside and build a corpus of 2 lakh rupees in 1 year, focusing on short-term investments. She wants to know what's the best way to go. Now, if she puts aside 10,000 rupees every month, that's 1.2 lakh rupees at the end of the year. Is it possible at all for her to achieve that goal of 2 lakh rupees?
There is a possibility that, if you are saving or accumulating 10,000 rupees a month in an equity fund, it just might turn out to be 2 lakh rupees. But it is extremely dangerous, if your investment time frame is just about 1 year. So this approach itself is ruled out if your investment time frame is just about 1 year. If you are thinking in terms of 5-7 years, then possibly you should consider, and you should approach it little conservatively through a balanced fund, or even lower allocation to equity, which is through a MIP, the growth plan of an MIP.
All right, a growth plan of an MIP. Dhirendra, would you be able to give her an MIP or two that she can choose from and use at this point?
If this 1 year time frame is a very strict, time frame and you need the money after 1 year, then I would say that just consider a recurring deposit or maybe ultra short-term bond fund, nothing beyond that.
All right, so recurring deposit or an ultra short-term bond fund. On your screen right now are the bond funds that we've recommended on the show in the past. If you have any more questions, of course, you can get back in touch with us. We have one more question for you, Dhirendra. Vishal has written in that he's been considering the HDFC Prudence Fund for this financial year as an investment. He wants to know, do you believe it makes the best bet? Now, given the list of options that we have within balanced funds at this point, Dhirendra, is HDFC Prudence poised for a good year from your reading?
Possibly, markets are cyclical, and so are, and some of the fund performance we have seen, particularly from HDFC equity funds, universe, that their performance can also be little more cyclical than the market. And Prudence has been an outstanding fund over the last 20 years. It has been the most rewarding balanced fund. But for somebody who's looking at balanced fund, I think there's a problem about this fund, which is to provide stability. It is always 30%, 30% at least into fixed income, which means if the market crumbles, this fund doesn't as much. So if you get upset with great volatility of mid cap stocks, this fund may not be suited for you. But if you are going to invest for over 5-year time frame and invest with regularity, and you are fine with ups and downs, which this fund will have, then it is an outstanding choice.
Correct. So you have to be prepared for the fact that once in a while HDFC Prudence, being a balanced fund, behaves like an all-equity fund. If you have any more questions, of course, feel free to write to us. We'll take a very quick break. When we come back, Dhirendra is going to stay with us. It's time for our product review. We'll talk about Tata Infrastructure and find out if you should give this fund any more time at all. Don't go anywhere. Welcome back. You're watching Investor's Guide on ET Now. It's time for our product review. This week, we're looking at the Tata Infrastructure Fund. Avan is here to give us a quick introduction. Avan.
Thanks for that, Faye. The fund in focus this week is the Tata Infrastructure Fund. Launched in 2004, it primarily focuses on companies in the infrastructure space. Since its inception, the fund has given an annualized return of 12.3%. After an impressive 2006, this fund's returns have been in line with the category average until 5 years ago, when it slipped to number 14 out of the 20 funds. In the next few years, the fund managed to regain lost ground, with returns beating the category average. Currently, the fund is ranked as 31 out of 47 funds in the category. The top 3 sectors are financials, energy and construction. Let's bring in some numbers then to give you a better perspective on the fund's performance over the years. If you invested 1,000 rupees in this fund when it launched, you would have 2,945 rupees now. So is this a good bet, or should you add this fund to your portfolio? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for those numbers. Dhirendra, infrastructure has been disappointing both as a sector and as a category of funds for a fairly long time. But we are seeing those particular stocks starting to turn around. There's a lot of hope in the market right now that a new government might be able to bring those stalled projects back on track. Do you share that optimism? Do you believe that there's good news around the corner for infrastructure funds?
Yeah, I believe that, but not because of the government. Yes, that can have a limited role. But infrastructure stocks doing, the turnaround in their stock price is a function of many other variables. One, that they were beaten down to a point where they were looking compelling value. The other is that after things go through cyclicality, and last 5-6 years they have been beaten down so much. But for this particular fund, I think it's about time. It has been a consistent underperformer. When we consider, of course, I think that this fund, being an infrastructure fund, unusually has a S&P, a CNX 500 at its benchmark. Which is not correct. But despite that, if that is its benchmark, it has not been able to beat its benchmark for nearly 5 years. That apart, relative to other infrastructure funds, it has been a disappointing one. Its claim to glory was its first few years, and after that it has not done well ever.
Then finally, the last time we reviewed this fund, you gave it 2 stars. What would be your rating this time?
Same as before, 2-star for its consistent underperformance, and generally investors should be out of such a fund.
Right, we normally look for consistency in a fund, but this is not the kind of consistency we want. It's time to sell out of the Tata Infrastructure Fund. Let's move on now to our hold or sell segment. Well, Srinivas has written in, Narendra. He tells us he has 2 questions. First of all, he has 5 lakh rupees he wants to put aside for 5 years. He wants to know if an FMP is going to give him good returns. But besides that, he also has a long-term portfolio that he's investing money in. I want to first look at his long-term portfolio, and then we'll tackle his short-term questions. Right on top is Reliance Banking. Now, we know that there is a positive view on banking at this point, given where the interest rate cycle is. But for someone like him, would you recommend banking in his long-term portfolio?
No, not at all. I would approach, as I keep insisting, and even at the, cost of sounding like a stuck record, that one should, and most ordinary investors should be in a diversified vehicle. They should keep away from anything which is, which is concentrating. And a banking fund is a concentrated banking fund. It will invest in banking stocks only. If you are a common investor, then be into a diversified vehicle and let that decision be of the fund manager when he wants to be little overweight or underweight on banking.
The next fund, of course, I'm sure is going to get a similar reaction from you. He has the ICICI Prudential Export and Other Services. Now, given the fact that it is somewhat of a focused fund, it has done really well over the last couple of months. What's your recommendation for this fund, Virendra? Should he hold on to it?
Yes, I'm actually, suggesting him, which might prove to be unprofitable. But over the long run, I think it will enforce discipline and he will be better off. Because when you are investing in this export, and there is a possibility that this fund will do well, or it'll keep doing well for many years, because it's not constrained by its by any sectoral exposure. But given the characters, export driven businesses are the one which will be competitive, and they will be deriving their revenue in foreign exchange in that sense. And if that export is to a developed economy, which means they will continue to benefit from a weakening of our currency over a long period of time.
In the interest of saving time, I'm going to ask you about the ICICI Prudential Technology Fund, which is going to be very similar to Export and Other Services in the portfolio that it holds. He also has SBI Pharma, which is also now focusing on a sector. Should he get rid of both of these?
Yes, absolutely. I don't see any reason why, and looking at, past performance, these numbers look very compelling. They will also be able to repeat in future good performance as well as bad, but it is not in your interest to be investing in these funds.
I want to take the next few funds together, Dhirendra. These are diversified funds. He has ICICI Prudential Focus Blue Chip, he has SBI Magnum Tax Gain, and he has the Emerging Business Fund. Now, over the long term, these funds do tend to take a certain focus. Let's start with Blue Chip. What's your recommendation on this fund? Should he continue to invest in it?
Yes, it's that fund. It's an excellent large cap fund, but it is not a kind of fund which he should be holding for a long period of time, because large cap fund will remain invested in large caps only, and he should be investing in funds which have a flexible mandate, and then the fund manager will take such a call. Likewise, the Emerging Business Fund, which potentially can be hugely rewarding, and this is a fund which does not say that it will be investing only in large cap or small cap, but a business which is in for a turnaround or on valuation front, it looks very promising. And this fund has stated, objective that it can assume huge risk to reward investors with potentially big gains, and many a times it may not work. So he should be aware of that. And he should be substituting, quite a few of these funds with fairly well-diversified funds which can invest all across the market.
Dhirendra, what about SBI Magnum Tax Gain? Now, he hasn't told us when he invested in this fund, so it's very likely that he still has a lock-in on that fund. Should he continue to hold it if the lock-in has expired?
Yeah, this is a fund which was a great fund about 3-4 years back, and then it lost its charm. It struggled. And now it has come back again on the forefront, and it looks like a very well-diversified, fairly well-disciplined fund which has made a decent comeback. So he can well continue to invest as well as hold this position. But most other funds, he should be choosing funds from our growth portfolio or our aggressive growth portfolio.
All right, so our growth portfolio is on your screen right now, but I still have to ask you about one last fund, Narendra, the DSP BlackRock US Flexible Equity. This is a fund he holds in his portfolio. I know that you personally recommend that we all have some sort of exposure to a foreign fund in our portfolio. Is this the fund to do the trick? If he moves to our growth portfolio, can he just add this one to it?
Yes, I think one should add to it, and for sake of some kind of active rebalancing on an annual basis, it should be a very well defined percentage or allocation to his portfolio. If it happens to be 10%, and this is a good fund to have.
All right, so there you have it. Unfortunately, Dhirendra, they're recommending that you sell almost all the funds in your portfolio except for Magnum Tax Gain and US Flexible Equity. And of course, our growth portfolio is the one that you should be using. It's on your screen right now. Get back in touch with us if you have any more questions. We have one last question on the show. Sheshadri Nagaraj has written in, Dhirendra, he's 54 years old. He hopes to create a retirement corpus of 1 crore rupees. Now, if he's 54, that gives us a maximum of 10 years perhaps when we can do that. He can invest 20,000 rupees every month. He wants to know if his investments are on track. Now, first of all, when we look at it, there are 18 funds in his portfolio. Might be one too many. Would you recommend before he does anything else, he just streamlines it and brings it down to a manageable number?
Yes, absolutely. And I think it is serving no purpose. At most, he should have 6-7 funds. Effectively, you have a very well diversified portfolio, and this portfolio has no focus. It is a bunch of well performing, poor performing, or average performing funds, and you are incurring the cost of investing in an actively managed fund. If you have to do this, why not choose an index fund? Of course, the index fund has a limited case, but I would say that he should be just restricting his portfolio with our growth portfolio or our aggressive growth portfolio, and he has all those funds in his portfolio. So all he has to do is consolidate his money in those 5-6 funds and actively realign to that.
Right, so our growth portfolio is on your screen right now. What you need to do is realign your portfolio. Like Dhirendra said, 6 or 7 funds is all you need really to be able to stay on top of this market. You don't need 18 or 19 funds. And of course, if you have any more questions about achieving that goal of your retirement, get back in touch with us. Dhirendra, thank you so much for answering our questions on Investors Guide this week. We look forward to having you back again soon. Coming up after the break, we'll tell you if you can buy a term and a health cover in India if you're currently an NRI. Don't go anywhere. Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. Now, we've brought in Anil Sehgal this week to answer all of the questions you had on insurance. Anil, thank you for joining us. Our first question comes in from Ramanathan, who writes in from Dubai. He tells us he's a 51-year-old NRI and he plans to move back to India when he retires. Now, he wants to know if he can purchase a term cover with a critical illness rider and a health insurance plan to cover all unexpected expenses once he returns to India. Now, right now, given the fact that his status is still NRI, Anil, which of these policies can he buy and what paperwork is he going to have to keep ready?
Ramanathan, you are an NRI resident outside India. Now, the thing is that for Indian health insurance plans, typically these are not available for non-residents because the health insurance companies are unable to underwrite properly or to administer claims. You will have to wait till you come back to India before you can switch to a Indian health insurance plan. So I'm afraid that there won't be a plan available for you.
Well, Avdut has written in. He tells us he bought a family floater plan from Reliance General Insurance. Now, he has a wife and a child he's insuring. He's had this plan for 7 years. He wants to know if it makes sense to switch at this point. Is there a better option for him? And will he be able to port all of the waiting periods? He also wants to know if the Birla Sun Life Child Dream Plan, for which he's currently paying 17,000 rupees as premium, makes sense because the value that he has right now is lower than the amount he invested. Should he hold on to it or should he pull his money out? Anil.
Avdut, you bought the Birla Sun Life Child Plan in 2007. Now, it's been 7 years since you've been holding this. However, this is a plan which was pre-2010 and therefore even after 5 years there is a surrender penalty which will apply. What you should do is ask Birla Sun Life for a current fund value and a surrender value of this plan. And since you've not mentioned the term for which you bought it, also ask them to advise you on what the surrender penalties will look like over the next few years of the policy term. You can decide thereafter whether you want to continue holding it or you want to surrender it based on the penalties which may apply. As far as your Reliance family health plan is concerned, there are a number of good health plans, family floater plans which are now in the market. Based on your requirements of either whether you want to increase your sum assured, whether you're looking for certain additional benefits, you can compare the plans compared to the Reliance health plan that you already have, and then accordingly decide whether you want to switch. As far as the question of portability is concerned, the portability will apply. However, if you change the sum assured, then there will be an issue in terms of the portability. Because the waiting period may not apply or the benefit of the waiting period may not apply if you change the sum assured.
Last question on the show. Mayank has written in, he'd like to buy a term cover of 1 crore rupees. Now he wants to know which company should he buy it from. He tells us he's done some research online and he realized that there's a very wide range of premium for the same cover. Some charge between 8,000 and some go up to 16,000. How should he choose and why is there such a massive difference in the cost? Anil.
Mayank, you've already compared various term insurance plans and you shortlisted a few. Now the thing is, in terms of why there might be a rate difference, all the plans are comparatively priced as such. However, Max, Aegon and Aviva are plans which require medical underwriting, whereas the ICICI Prudential plan, for instance, is a non-medical plan which does not require medical examination to be done based on sum assured and age. And so they are priced differently. Now, based on convenience, based on your own requirements and based on your comfort with various insurance companies, you could choose any one of them because they're all fairly comparatively placed.
Anil, thank you so much for answering our questions this week. Now, if you have a question about insurance, mutual funds or anything to do with your money, write to us. Email ID is at the bottom of your screen. You can also reach me personally on Twitter. It'll be my pleasure to hear from you. Tune in next week to catch Investor's Guide. Thanks for watching.